Emilio is the lead banking and capital markets director at Ernst Young. What's the state of the industry in this country, Emilio?
Good afternoon. Unfortunately, the index shows a decline in confidence over the last quarter, which I suppose, given the points that you just raised, is probably not a huge surprise. I suppose from our perspective, we've seen over the last couple of years investment banking have a more direct impact from a confidence perspective to global shocks, and as we've seen in the uncertainty in the European markets, it was expected. On the retail banking side, probably more domestic market, we didn't expect the extent of drop in confidence, but we have seen that in the last quarter on the retail side as well.
Yeah, let's have a look at the numbers now. It says the banking confidence index fell overall from 89 in the first quarter to 78 in the second quarter. I mean, percentage terms, that's a really, really big move. What is it linked to? Is it linked directly to banks and the way they behave and the way that the sort of services they're providing, or is it directly linked to the economy? Because obviously the financial services sector and therefore the banks are inextricably linked with the economy. So which one is it, the economy or the banks themselves, or both?
I suppose it's a bit of both. Maybe just to provide some context around the survey, it's a quarterly survey that we've been conducting with the BEF over the last 10 years. And effectively, it's a survey of the banks around what they see their confidence in the banking market. So I suppose it is a combination of what they see out there in the market that they service, but also internally.
Okay, here's some other findings that I'm reading here from your survey. Rising credit losses in retail banks, with investment banks' losses shrinking. Oh, yeah, the other thing I'd note, I might bring up with you actually, is the margins that investment banks are managing to command at the moment. I think they're shrinking as well. Second point, significantly weaker investment income for all banks alike. Flat headcount at retail banks with rising headcount for investment banks, that's strange, and stronger interest income growth for both retail and investment banks. Let's go to rising credit losses in retail banks, because that's been a theme over the last a few weeks. How bad is it? Is it a dangerous situation?
I suppose you have to look at it in the context that we have seen that coming down over the last 2-3 quarters. And I suppose you mentioned the drop earlier. That's also in the context that the confidence has been rising quite strongly over the last 3 quarters, from a low of 38 points all the way up to 91. So the drop that we've seen in the last quarter have to be looked at in that context. And similarly on credit growth and impairment growth, there has been a significant drop over the last 3 quarters, and we've seen that slightly rising. So I suppose it's maybe just a bit of a, if I can call it, a reality check for the banks in the last quarter, that the improvement that they've seen coming through is probably not as strong into the future.
Was the ABSA trading update too late for your survey? I would wager it was.
The survey doesn't specifically look at individual banks, but it is a survey of the banks itself, and ABSA is part of the population.
Yes, indeed. Significantly weaker investment income for all banks alike. That was the second point. Again, is that it's just a function of the sluggish nature of the local economy, surely?
Definitely, and I suppose most of the indicators and the points that you raised earlier is a clear indication that things are starting to slow down a bit, and there is pressure based on what, from a corporate perspective, the corporate market, we've seen the recovery and the rate of growth not meeting expectations over the last couple of quarters. So although we have seen some slower growth, it hasn't been as strong as what we would have hoped. I suppose maybe to highlight the one positive is the fact that we are seeing some credit growth, and especially on the retail banking side, which we haven't seen as strongly come through in previous quarters. So it does mean that with credit growth, credit extension is definitely picking up, which is resulting in improvement on interest income for the retail banks.
Yeah, on from the retail banks to the investment banks. I think when you looked at the Facebook listing and you looked at the sort of margins that they were paying, or the sort of commissions that they were paying to whatever advisors they employed, a couple of the big names that we know of, they were tiny compared to the sort of glamorous numbers that we've experienced over the years. Is that a trend? Are people saying, look, if you want to do business during these fairly tough economic times, we are going to pay you this, and that is that? Is that a trend?
I suppose if you look at the competition in the banking sector as a whole, definitely more pressure on fees, and I agree. I do believe that in looking at the volume and number of transactions that's available out there, and a number of banks chasing them, there will be, as part of that competition, pressure on the fees.
You conclude the following, Emilio. You say retail banking fundamentally remains sound despite the continued uncertain global outlook. Investment banks, on the other hand, you say continue to feel the impact of uncertainty more directly, with respondents reporting shrinking profits in the second quarter. Looking ahead, the question is how banks will manage a cycle of rising interest rates. Well, interest rates are being cut, so maybe they won't have to endure that. Just as we conclude this, what is the future of banks, given what's gone on with Bob Diamond and the investment bank on Wall Street that lost 2.2 billion, which could become 5 billion? Is there going to be a backlash, and is there going to be a fundamental shake-up of the industry? For example, Barclays being split up and then going further, and that's spreading to other banks. Has this been a watershed period for banks, do you think?
I suppose if you look at the last couple of years, the proposed new regulations coming in, and on the one hand you look at Basel III, which to some extent was looking to address some of the shortcomings of the Basel II framework that was identified through the credit crisis, but also significant events. I think you can go all the way back to Barings, where in hindsight the regulators have identified certain weaknesses, and that as part of the bigger discussion around the improvement of regulation to make the banking sector more secure, if I can call it that, it will definitely feed into that process. But I don't necessarily believe that individual instances will necessarily change the banking sector per se, but it does definitely add to that discussion and debate that's currently underway around the global regulatory reform required in the financial services sector.
Emilio, thanks very much for your time this morning. Very interesting chat. That's Emilio Pera, who's the lead banking and capital markets director